All right, once again, good morning, everyone. Welcome to this morning's webinar. Again, my name is Bernard with Insurance Advisors Direct, and we are pleased to have you with us today as we talk about sales concepts and solutions. But before we get started, I'd just like to take care of a little housekeeping items. So currently, everyone on the webinar is muted, but you can ask questions simply by typing it in, and at the end, we will field those questions. Also, like you know, this webinar is being recorded and will be available on our YouTube channel, I believe 48 to 72 hours. Then also, I will be contacting each and every one of you after the presentation to see if you have any additional questions as well. Well, without further ado, we have Tim Burns and Andy Jones from Assurity, and they're going to take it from here. All right, my friends.
Thank you, Bernard. Thank you for having us today. We really appreciate it. We appreciate all of you making the investment this morning with your time. My name is Tim Burns, as Bernard alluded to, and just wanted to share with you here the layout for today. We're going to begin really having three parts to today's discussion, starting really to go back and focus on who is Insurance Advisors Direct, the value that they bring to you, the role that Bernard plays in helping you drive your business. We're going to then go back and just kind of talk about how do we begin to take some of these product webinars that we've been doing, Assurity has been doing with Insurance Advisors Direct, and how do we begin to really turn the corner and start having conversations with our clients to drive sales and drive revenue. And then what does that really equate to if you take some steps, simply trying to do some additional business throughout the year. And we're going to look specifically at some winning strategies today using our single premium whole life product. As we go forward, and if this is the type of webinar that does well for you, we're going to keep this format. We're going to look today at single premium whole life, but we can look at the term insurance. We can look at whole life as well. Bernard has recently asked folks to share some feedback through a survey, and we're going to use that survey information to take very targeted approaches to concepts as it relates to your business. And then just kind of as we go to wrap things up today, we'll talk about really what the benefits are to adding additional products, ancillary products, away from the normal core, and we're going to talk about next steps. How do we get started? So with that, I'm going to turn it back over to Bernard. Those of you who know Bernard may know a little bit about his background, but some of you may be working with Bernard and not know. Bernard's been in our industry for nearly 20 years. He joined Insurance Advisors Direct just 2 years ago, but his background has been built around the life insurance and health part of our business as well as the property and casualty business. So he has a very strong, diverse background where he can assist you with your business going forward. Currently, his focus and expertise is both on the life and the annuity side. So with that, Bernard, I'm going to kick it over to you. We're going to let you talk about the 7 pillars of success that Insurance Advisors Direct brings to the advisor base, as well as building positive behaviors.
All right. Well, thank you, Tim. All right, folks, as you know, who is Insurance Advisors Direct? Insurance Advisors Direct, we are a full-service FMO whose mission is to simplify your success. And we do that through our 7 pillars of success. One is our product offering, marketing services, lead generation, technology, sales tools, training and education, and administrative services. So what we're focusing on today is of course, our product offering, our sales tools, and our training and education. And which leads into our next slide. So our biggest sales tool, and this is for any salesperson, our biggest sales tool is the human mind. From that is that the human brain is the most complex thing, but actually the simplest thing a salesperson can use for a sales tool. So, and what I wanted to do is, and just let me give you a little background. I was on a charter school board of director for 12 years. 9 of those years I was the president. And one of the things, and I took the premise of selling into that same concept of educating our kids, because everything is all based on behaviors. And I mean, we're dealing with sales folks, we're dealing with adult behaviors, and schools are dealing with children behaviors as well as adult parent behaviors. So, and it doesn't matter. The behaviors are started in school, and we may not believe it, but the same behaviors that we acquire as children are the same behaviors that we have as adults. So, I mean, how does that work with selling? So, when we meet with our clients, we have our 8 tips to jumpstart your sales inspired by psychology, which is Brian Tracy, and he's foremost seller, and he uses these concepts. And actually, the concepts that he has here, I mean, and they're just textbook things in Psychology 101. So the first thing is when we're with our clients, and they're all looking at first impressions. And humans, we're emotional creatures driven by habits. But we also have that logic side to us. So pretty much what we want to do is focus on that emotion first. So here it says our brains are wired to focus on emotions before logic. So, and first impressions have a big impact on what your client ultimately decides about you and your product and service. So that's why it's crucial to focus on making customers feel good on an emotional level before following up with facts. Now, we do logically first. If we're logic first, that turns our clients off. So we always want to be emotional or show some type of emotion or tell a funny story. Then there's cognitive dissonance, and this is actually one of my favorites because I'm working on my master's in industrial psychology and positive psychology. So get clients on board early. So cognitive dissonance is the idea that people are committed to a certain perception of themselves that they will tend to avoid putting themselves in a situation that negate this perception. So Rene Descartes, I think, therefore I am. So we want to get that person on board with their perception of themselves as well as their perception of you, and have a want to get your products and services. And then, folks, we like to follow the crowd. And well, here's what other clients think. You always bring this is what my clients, this is where folks are going towards now. So humans are social, and your clients like to know that other people are benefiting from your product or service. Being able to share positive feedback from prior clients, or even simply starting a sentence with the phrase, here's what our other clients have done. And that can go a long way toward reassuring your clients. Then, folks like stories, not statistics. So the power of anecdotes, and that goes back to emotions. We're emotional creatures, so we pretty much buy by emotions. A fifth is scarcity. Now, this may not fit so much into the insurance world, or you want to say for a limited time only, because we do want to be as transparent as possible, and we don't want to say things that aren't necessarily true. 6 is build confidence by giving and out. Client feels comfortable about their relationship with you, will be more confident about closing on a sale. Now, although it might sound counterintuitive, giving clients an out or otherwise maintaining a low pressure attitude will build your client's trust. And then sometimes, us insurance folks, we have that bad persona that, we're that high pressure attitude. But no, keep that low pressure, build that confidence with the client, and then that will be a better way for you to close the sale. And then there's reverse psychology. Let them sell themselves. And actually, this is a good point here. And although this point isn't technically reverse psychology, it's a similar idea. You give your client reasons to to defend what you're selling by mentioning that they seem to be more interested than you expected, or that you're not sure whether a product or service is right for them. Let them hold credence to themselves and say, well, I think this product is good for me. And that's your way to close the sale. And then finally, what's in it for me? In people, we all like shiny stuff. So we have to show them value. What makes this product or what makes this benefit stand out? Why or what will this do for me? And those are just little 8 simple tips, psychology tips that will help you be more confident in offering that sale or closing that sale, whether it be Medicare Advantage or MedSup, life insurance, annuities, whatever the case may be. These 8 tips here will help you through that process. And then, like I said, we can get more in depth into this. I know later on I'll actually put up more slides or more presentations on psychology and how that will work with our sales process. So, those are some of the things that is unique about Insurance Advisors Direct. Besides the 7 pillars of success, the agents here, we're agents first, just like everybody on this webinar. And for me, for over 20 years, and like I say, I'm that psychology guy. I love I like to know how the human mind works. And selling is the perfect environment to figure out how that human mind works to get that person to sell or buy your product. Now, I'm not going to lie to you. I've had many successes and many failures just using this, but that's the nature of the beast. We want to get out that comfort zone, and we want to do what's uncomfortable, make it comfortable. And just a simple example, me, I'm an introverted type guy, borderline shy, and it's uncomfortable for me to talk in front of a bunch of people, especially on this webinar. But I do it because I like doing what I do. So I step out my comfort zone, and I think I'm fairly good at it. So like I say, if I can do it, folks, you can too. So I'm going to turn this back on over to Tim and let Tim do his thing. Go ahead, my friend.
Appreciate that, Bernard. And I think it's important. Bernard and I had the chance to sit down together a few weeks ago and really talk about how do we take this relationship between IAD and Assurity and really make it effective for your producers. And today, Bernard, I think you've been able to demonstrate to me what it is that IAD does. Sorry about that, for the advisor base and the strengths that you bring to the table as you work with them day in and day out. So we appreciate that. For me, folks, I just want to make sure that you're clear what we're really trying to do today. And we're really going to talk about how do we take and turn product overviews, which is what Assurity's been doing, is we've been sharing with you our product suite, and how do we take that next step and turn it into sales revenue for you as the advisor. And so as we move forward, we're really going to begin to explore what is that profile of the ideal client given the sales concept? What is the solution that you're going to deliver? What are those value adds, the benefits to the clients themselves? And we're going to talk about how do we start that conversation? How do we handle any type of common objections that we can expect to come up? And then give you an example or two of a close that goes with that particular concept so that we can bring it home. Now, as I talk about that, one of the things that we really have to understand is what is meaningful revenue? Right? What is that to you? Because if it's not meaningful, you're not going to invest the time because your time is going to be more valuable somewhere else. So as Bernard and I kind of talked about what a lot of advisors in their producer base look like, one of the things that we felt was true is that most folks are going to have some kind of a 5-year average in our business. A lot of folks are going to be focused on the Medicare Advantage type of sale. And what does that translate into? What does that mean? Well, if a person sells first year 100 lives and they're being compensated at $472 on each of those lives, they're going to make just under about $50,000. But having been in the business and having some strong persistency and retention of those former clients, let's assume there's about 400 renewals years 2 through 5, they're paying about 50% of that original day one premium. And what that means is somebody's going to be making, in this situation, about $140,000 a year. Now, that may not be you specifically. It could be a little bit less. It could be quite a bit more. But we feel as though that the typical advisor working with Insurance Advisors Direct today is going to be making around $135,000 to $150,000. So what is meaningful revenue? What does that translate into? How do we help offset some of your overhead costs? And how do we make doing additional business worthwhile? And so as we look at this, 3 concepts we're bringing to the table today are going to generate revenue somewhere between $1,100 for one particular sale example that we give, upwards of $3,200 for an example that we give. And if we look at perhaps doing one of each of the concepts in a given quarter. So each month we're doing one, we do one of the other, it's a mix. We might drive just a little more than $6,000 a quarter, or approximately $25,000 of additional revenue in a 12-month period of time. And it doesn't have to be done that way. It doesn't have to be done one a month. But I wanted to break it down and make it simple so you could understand, because we do know that enrollment periods are likely in the type of business that you're in. We understand that those enrollment periods are laser focused, but there are times during the year. And one of the things we're going to do at the end is we're going to talk about benefits beyond this revenue. What is it that we can do with that customer base to ensure that we have the renewals years 2 through 5? And how do we take advantage of cross-selling our clients? So what you could do is perhaps do 12 of these sales. We're going to share 3. So if you did one 4 times each over the next 12-month period, we do believe that you would drive approximately $25,000 of additional revenue. And to me, I think proportionately, if you are somewhere between $135,000 and $150,000, I think $25,000 of additional revenue should be meaningful. Now, what I want to do next is talk about a quick review. So we didn't want to spend a lot of time today going back over the things we've talked about, but we do want to just take a quick moment and remind you who is Assurity, what type of an organization we are, and then we also want to talk about the particular product that we're going to focus on today, and that's our single premium whole life. And so if you bear with me here over the next few minutes, we're going to review this very quickly. Who is Assurity? Well, Assurity has more than 125 years of experience protecting individuals, families, and small businesses, plus the financial strength to back it up. We look at our distinct and diverse products, and they're competitively priced, and we cater to the needs of clients across the board. We have an excellent rating with the firm AM Best, which is an A- rating. There are industry's leading independent analysts. And you're also going to see there on the right-hand side that we're a certified B Corporation. Now, what does that mean? It means that we balance purpose and we balance profit. We are committed to social and environmental responsibility. In fact, Assurity was the first major life and specialty health insurer to become a certified B Corporation. And that just means that we're demonstrating that we meet the rigorous standards of social and environmental responsibility. Again, it's this idea of balancing purpose and profit. So what it is a designation given to for-profit organizations, a nonprofit group. We're very proud of that. Now, if we look to say, how are we different? Well, we are still a mutual organization, and we believe that we're in the business to serve the interests of our policyholders. And one other thing I would point to here is that we have prompt and personal service. You can expect high-touch service, and we're never more than just a phone call away. You're actually going to have a live individual answer the phone call when you give Assurity a ring. Now, who am I? Again, I'm Tim Burns. I'm your regional sales manager for Assurity. I'm out in the field, and while Insurance Advisors Direct is in Michigan, we understand that not all of you are going to be located there, but regionally I support them face-to-face. My counterpart, Andy Jones, works in our home office. Andy is on the line today and has led several of the webinars to this point on the product review side. And Andy is in there every day helping you navigate Assurity and helping push your business through in good order. So we appreciate what Andy does. Now, let's look at the single premium whole life product that I talked about that we're going to actually focus on today. Some of the high-level details that are important for you to understand are going to be that the product is issued basically from 15 days, meaning that a fairly newborn, through age 85. So this product is one, and while we understand a lot of your business is focused on pre-retirees and retirees, this is one that you can actually sit down, have a conversation with your client base about that can even extend out to their grandchildren. Okay, so we like this idea. The face amounts are very modest in order to get a policy started for someone who's very young to age 54. The minimum face amount is $10,000. Depending upon the age of the client, the amount that is required to pay into the single premium product to buy that $10,000 is going to vary. But it's not going to be a big dollar amount. And then, of course, as people are a little bit older, some of the pre-retirees and retirees that you work with directly each day, that minimum is only $5,000. Now, our underwriting classes are very simple. On the adult side, we're going to have folks issued at standard non-tobacco or standard tobacco. And for our youth, we actually now have a juvenile rate, which helps competitively price the product according to your client. One of the things that Assurity does, if you've been on our past webinars, is we really promote non-medical approach to underwriting. This is where we ask that your clients fill out the paperwork, and we help them avoid going through an exam or doing the blood and urine analysis. And a lot of clients appreciate the ease of doing that type of business. For us, with this particular product, your clients can literally be up to age 60, buy up to $700,000 of death benefit, and still be within the non-med limits. And your older clients, 61 to 85, can go out to $450,000. An example I would share with you that Andy and I worked on earlier this year was an individual man, 81 years old, had $100,000, looking to reposition those assets for a wealth transfer sale, and was able to go through our non-med approach to underwriting, and it just floored the advisor. It's just unheard of anymore today in the business. But that is something that I would highlight and point out to you as we talk today. Now, this next slide is going to talk about some of the riders associated with the product. There are two or no-cost riders. One is what would be considered a terminal illness, the accelerated benefit rider. This is where your client has been diagnosed and unfortunately has a very shortened life expectancy. They would be able to accelerate a portion of their death benefit up to $250,000, always making sure that the face cannot go less than $10,000, but it would be the ability for them to have a living benefit associated with this policy. And then the single premium insurance rider is a rider that allows really for us to blend the premium into the policy to either buy additional death benefit or to drive additional early cash value. And we can talk about that here a little bit further. Now, what has changed? So some of you who may be familiar with us, who have sold this product before, you'll realize the product was updated in November. With that, we repriced the product, which is to say that we updated the pricing to be in line with the 2017 mortality tables. So ever so often, new life expectancy tables come out, and insurance companies are required to reprice their products. And we repriced this, and the new product launched in November. What this did with the reprice is it drove higher death benefits for your clients. It increased commission for you. I think it's safe to say the average commission for you working with Insurance Advisors Direct is going to be about 10.5%. Is normally how that's structured at the street level. And then increased our maximum issue age from 80 to 85, realizing there were still clients out there who were insurable, who had interest in repositioning their assets. We had that juvenile class, as I mentioned. And then, of course, now we've taken our single premium insurance rider out through Table 8, which is very beneficial to you as an advisor when we have a client with some challenging health issues. So that was their quick review there. Now we want to shift gears. We really want to begin to focus on how do we take the idea behind that product, working with a company like Assurity, what we stand for, and partner with Insurance Advisors Direct to put some money in your pocket. We're going to title this Winning Strategies, and again today we're focusing on the single premium whole life product that we have to offer. We're going to look at three particular concepts, first being wealth transfer. And as I mentioned, we're going to talk about the ideal profile of the client, the solution that we're presenting, how to start the conversation, how to anticipate what objections you may run into, and then we'll give a sample close or two as it relates to each. After the wealth transfer concept, we're going to look at 10 1035 rescue plan. And then we're going to talk about some of your clients who are sitting on cash positions, and in their mind, they're self-funding their final expense. And we want to talk about how we can help them do that in a more efficient way. Okay. Now, beginning with wealth transfer, what I would share with you is the ideal client typically is 60 years of age or older. They're relatively healthy. They have non-qualified assets that they want to pass on to their heirs. And when I say non-qualified assets, I'm really referring to money that they've received. It's been taxed. It's maybe sitting at a bank. Maybe it's at the credit union. But it's basically a cash position. It could be in a certificate of deposit with one of those institutions. It could even be a non-qualified annuity that they're holding that is set to pass on to their heirs as well. And the idea here is that we have clients who do not believe that they're going to need this money during retirement, but they still want to maintain access, right? So they don't want to give up full control, but they're sitting on some cash. In this situation here, we're going to look at Marcia. She is 72 years old, and she has $30,000 in a CD at her local financial institution, whether that be a bank or a credit union. Obviously, we've been in a low interest rate environment, and she's not earning much interest, and it's frustrated her to some extent. But to add injury to the insult to injury, Marcia, of course, as you know, when a person has that, the interest earned is reported as taxable. So she's paying, that goes into her overall income for the year, and she's paying a form of tax on that little bit of interest that she's earning, and that frustrates her just the same. She's actually afraid of riskier investments. Well, why is that? She's 72, right? I mean, it's a point where your risk tolerance becomes more conservative by nature, and that's where Marcia's at. So that's why she likes the CD because of the safety aspect of it. But unfortunately, it's just not producing any type of return. And she was really hoping that this money would be passed on to the grandkids to help with college expenses. And while it's not a lot maybe today as far as the overall portion of her assets, the idea is she would like to get some return so that it grows in value and there's more to pass on to the kids at the time they're in school. Now, I would point out one thing that you have to keep in mind, and that is that when a single lump sum of money goes into a life insurance policy all at once, if this money is not coming from another life insurance policy where it's a 1035 exchange, what we're faced with is something called a modified endowment contract. We put too much money into the policy too quickly, and we violated the insurance corridor. And what that means is that we often refer to it as a MEC. MEC is just simply an acronym for a modified endowment contract. And what that means is it's going to be taxed similar to a non-qualified annuity, and that is last in, first out approach. So the last in a insurance policy would be the dividends, for example, in this situation where it's money comes in as a single premium deposit, say $30,000 goes in. If that value of the policy has grown to $31,000, that $1,000 of gain is going to have to come out of the policy first, last in, first out, and it's going to be taxable to her down back to the cost basis. Okay, so keep in mind, just like a non-qualified annuity works, when we put too much money into a life insurance policy, and that happens often when we're talking about after-tax dollars and a single premium approach, it becomes a modified endowment contract. It also means that any withdrawals that a person would take prior to age 59 and a half would face the same penalty that the annuity would of 10%. So that could apply depending upon the reason they're taking that distribution. And again, just as always, the cost basis is never going to be subject to taxation. But there are benefits to why a person would do this. Ultimately, even though it makes the policy, there are reasons why they would do that, and that's what we're going to look at here next for Marcia. So Marcia buys the policy. She puts all $30,000 towards the base premium. That is to say, she's not using the single or the our rider, the paid up the single premium insurance rider. She's putting it all towards the base, and what this does for her is it buys a guaranteed death benefit of just under $41,000. So if something happened to Marcia, and while she's been holding the CD at the local credit union, she's not earning a lot, right? It's not growing very quickly. And if something happened to Marcia tomorrow or next year, Today, the only $30,000 plus that interest earned would go on to the grandkids. Today, we know that she's been able to leverage that for basically an additional $10,000 to $11,000. So there you begin to see the immediate benefit of a single premium whole life policy. Now, on the non-guaranteed side, and this is to say that dividends have been paid, they've been put back into the policy in 15 years. So Marcia's 72, life expectancy would be age 87 approximate. Over the next 15 years to life expectancy, that death benefit can get pushed upwards of $50,000. And I would tell you, you can do the math all day long, there's no way that CD is going to grow to be $50,000 in 15 years' time based on our current interest rate environment. So that's the type of leverage, that's the idea of this wealth transfer opportunity that this product presents. And you always want to look at the pre-tax equivalent if you're having a conversation with the client around that internal rate of return, because again, that's where we can point to the fact that the CD rates outside aren't paying anywhere near where they need to be a different approach here for your client. So now, how do we begin the conversation, right? So we talk about what does this ideal client look like. We talked a little bit about the fact it could be a modified endowment contract, and we talk about what the solution looks like for her. Well, getting the conversation can kind of be the biggest hurdle for an advisor who's not really in their comfort zone. And so we're just going to present a couple ways here that you could start the conversation. And what I've been able to do is we'll just read through these very quickly. I find many retirees have money in CDs and or cash accounts with the banks and the credit unions. Do you have similar funds that are earmarked to give to loved ones someday? Right, so you maybe just met the individual, or you've known them for a little while, or maybe they're an existing customer of yours. How do we take and turn the corner so that we open up the door to have this conversation? And I think it's again, very common approach here. I have many retirees that have money in CDs or accounts, or I find that many do. And they just have it there because they plan to pass it on to loved ones. Is that your situation, right? Or how about this? Has anyone ever shared with you one of the most effective ways to reduce your taxes and enhance your legacy? Now, that may be a little bit too salesy for some folks, but I really like the way that that's framed, because what you're able to do is point out the fact that, again, the CD money, the bank money is earning interest. That interest is taxable. People hate paying taxes, right? So how can we help her reduce that? Well, when we put our money into a life insurance policy, not only do we have that tax-free death benefit that's leveraged for the heirs, but we also are able to grow our money tax-deferred inside the policy. So immediately, she is not paying those taxes. And how do we enhance the legacy? Well, we saw that. That $30,000 has been immediately leveraged for almost $41,000. If something happened to her today, or out to life expectancy, that 30 has been turned into 50 on the non-guaranteed side. Now, I would tell you that this is the sale, this wealth transfer idea, where if we move that $30,000 at about a 10%, 10.5% payout, you're looking at this type of approximate commission would be $3,100. That being said, again, people have different amounts of money. My grandmother used to keep a CD with Chase Bank, and it was $100,000. And at the time, she passed away a year back in December here, at age 97. But that money at Chase Bank was a substantial amount of money back in the 90s and early 2000s when she had that. Now we didn't have life products that would be issued to her at her age. And so we ended up putting that money into a non-qualified annuity, which did very well over time. But what are some common objections that you might face with Marcia, again, who's age 72, who's got this money tied up at the bank with the CD? Well, for her, maybe this is not a priority, right? Maybe for her, she has always felt that permanent life insurance is expensive. So when we talk to her about whole life, even though it's a single premium and she doesn't have ongoing payments, it's this idea that it's an expensive product. Or, you know what, she just has never been comfortable with life insurance. She feels it's too complicated. And so perhaps that would be the type of an objection that you might expect from one of your clients. Now, one of the most powerful and eloquent ways or methods of putting objections behind you is often referred to as the feel, felt, found technique. Again, that's feel, felt, and found technique. After the prospect voices an objection, you can tell him or her, I know how you feel, right? I know how you feel. This shows you have listened and understood, right? And then we can continue. Other people have felt the same way, right? Felt, feel, felt, found. So I know how you feel. Other people have felt the same way. A statement acknowledges the importance of what he or she is feeling and lends to its legitimacy, right? Finally, you would say something along the lines of, and what they have found, feel, felt, found, is that, fill in the blank, whatever it may be that's their objection. This provides your prospect with a logical justification for moving ahead with the sale. So again, one of the most prominent approaches to objections is this technique of feel, felt, found. I know how you feel. Other people have felt the same way. And what they have found is, right? So let's say it is not a priority. What would be the approach? For someone like Marcia at 72, we could really start to create this sense of urgency. We could talk about her insurability, right? While she's healthy today and things are good, it doesn't take but till tomorrow for that to change, right? Tomorrow she could have, we see she's wearing a sun hat. Well, what if she has, maybe tomorrow we find out she's got skin cancer? What if tomorrow, she has a mild stroke? We know today that there's insurability that's available to her, but that could be gone tomorrow. So we talk about this sense of urgency when we have it not being a priority. It's something I can take care of later. The other idea is that we know insurance is priced on current age, and we know that you're never going to be young you are today, right? So if she puts this off, another approach to the sense of urgency would be the idea of being able to buy more death benefit for her heirs, creating a more enhanced legacy by doing it today versus putting it off next year, because next year at 73, it's not going to buy as much death benefit as she would get this year. What about this idea of the life insurance being too expensive? Well, refer to tax advantage of life insurance, and we can show that internal rate of return. Again, there's this pre-tax equivalent return that's necessary, to keep pace maybe with, inflation, for example. And then we can also highlight that this is a single premium product and there are no future payments required. And what about it being too complicated? Well, it's always a good time if somebody feels a product sale is too complicated to take a step back. And when we take a step back, what we really want to do is help them to a point where they have just the basic fundamental understanding of what we're trying to show them, what the solution really is. And again, I would come back and I would highlight the tax advantages to them, which would be that tax deferred growth, right? And then that tax-free death benefit to their heirs. Now, we talked about who the client is. We talked about the solution. We've maybe given an idea or two how we might be able to introduce the conversation, and we've talked about what those common objections are going to be. Now let's talk about how do we move it forward? How do we know that we're at that point that we've gotten beyond the objections and we can actually now move towards a close? And what I would share with you here is that, based on all the benefits this provides you and your loved ones, is there any reason we should, is there any reason we shouldn't, I apologize, we got a typo here, shouldn't begin the application today, right? Or are you ready to move forward? If so, we can begin the paperwork. Or how about this? Unless you have more questions, I think we should start reducing your taxes and leveraging your money for a better return right away. Right? And those are sample closes where if you get that agreement, you get that head nod, we know that we're now going to move on to that next step, which is the application. Okay. Now we're going to keep moving here. And again, at the end, we should have time to open it up to some questions. Folks, if you have those, just go ahead and type them in now. Bernard will keep track of what we've got. And as we get to the end, we'll move through them. The next sales idea is a 1035 rescue plan, right? And I'll share with you here a little bit about why we're focused on 1035 rescue plans. And that is, if you've been in our industry for any period of time, you're going to remember when Universal Life first came out, there was a high interest rate environment at the time, and illustrations were being shown with crediting rates. This example we're going to look at is 9%. But illustrative rates back then, crediting rates were much higher than they actually turned out to be. And because of that, policies weren't getting the credit. They weren't being, the cash value wasn't growing. They weren't performing as expected. And a lot of policies, as they were illustrated, are actually now set to expire, lapse, is the terminology we use, sooner than they would otherwise, right? So it was common for people to illustrate 8, 9%, or even double-digit crediting rates back in the day. And these rates have steadily declined, as I mentioned, over the years, and as a result, many of them are set to blow up, essentially, unless the clients are willing to pay additional premiums. And that's the example that we have here. So we've got David. He's age 58. He's still married. And he bought this policy in the 80s. He bought $200,000 worth of death benefit. As I mentioned, that there was a 9% crediting rate, and he's always gotten his statements, but he's really started paying attention to them here recently. And what he sees now is that the policy is projected to lapse, meaning that any money he's put into it is now gone. The death benefit is gone, and so this lapse notion, this idea of in another 5 years, it's going to be off the table, is really going to say, hey, look, you got one of a couple decisions: let it ride out, pay more premium, or decide to do something to close out, count your losses, and move on. And so where he's at is he's saying, I'm assessing my situation. The kids are out of the house. I've been able to save well for retirement. I may not have everything I need, but I do think we've done well. And he's not so sure that the life insurance is still necessary, right? And that's kind of where his concern is. Is this still necessary? Do I really need to have a death benefit today? Well, one of the things that we can do for David is put a plan in place where we take the $18,000, we exchange it. So it's a 1035 exchange. This is not a modified endowment contract unless the first one was. If it wasn't, then he's got all the traditional benefits that life insurance can provide. And what we're able to see immediately here is that $18,000 is leveraged into a death benefit of approximately $31,000. Now, it becomes essentially a paid-up policy because there's no more premiums that he has to make into it. And he hasn't given up control. He still has access to that cash value, that $18,000 that he exchanged over today. If David chooses to do so, that current premium can be reallocated maybe towards some long-term care insurance, maybe towards, a better health plan for him and his family. Maybe he's going to take that additional premium and buy some critical illness insurance to provide gap coverage, whether it be for his disability policy or his health plan. So there's lots of ways that when you free up that current premium flow that he's been paying versus where the alternative was of having to pay more, you're in another position to get an additional sale as well. This policy is a participating policy. I failed to mention that when we talked about the single premium whole life product earlier, but it is participating. It means it receives dividends when dividends are paid. And that can help drive the cash values inside that policy. And if we look ahead, again, David is 58 today, but as we move this forward, that $18,000 has been able to push the $31,000 of guaranteed death benefit on the non-guaranteed side with their current dividend scale out to $50,000. And what we believe then is, of course, that's going to be enough to really, pay for funeral costs, put some additional monies into the retirement plan for his surviving spouse. And so, again, a lot of benefits that you would have in your story as you share that with your clients, your prospects. So how do we get started? Again, similar approach. Do you own permanent life insurance? We're asking that because we're looking for folks who bought it some years ago. Is it performing as expected? Right? They may or may not know that. So here's how you might, reposition that conversation starter. When was the last time you reviewed your life insurance? I've jumped to the third bullet. Or that second bullet, permanent life insurance, like other assets, should be periodically reviewed. If you'd like, I would be more than happy to look over your most current statements, right? This is setting the stage for you to talk about the benefits that this solution could provide. What are some common objections you may have in this type of situation? Well, again, we know that David doesn't necessarily believe that the coverage is needed. He's been in a situation where the policy has underperformed, and he may have a lot of concerns about going from one life insurance policy into another, right? Or what about, this idea that he thought for a moment he was going to liquidate his policy, have $18,000 in his pocket, and he may have already thought, well, I don't need it today, but it'd be nice to have down the road for any medical expenses that we may have, if there's a special trip that he was thinking about. So this idea of access to funds. So I would go back to this idea of overcoming objections. We want to listen carefully to the objections itself. And even though you may have heard the objections 1,000 times before, you must allow this prospect, this individual, to voice their needs and their concerns to you. You have to make sure you understand what lies behind the objections, whether it be fear, whether it's a threatened self-esteem, a lack of financial resources, or so on. And so here, what I'd say is we never argue, of course, with the prospect. If you allow the prospect's objections to degenerate into an argument, you'll almost always lose the argument and the sale, and any goodwill that you have with that individual will be lost. We're going to acknowledge the objections. If you seek to diminish or dismiss the objections, you're showing disrespect for the prospect. Instead, we want to confirm the importance of what the prospect is saying. We want to make sure that it's sincere in your effort, right? And look, let's say they say it isn't needed. How do we counter that? Well, let's play on a person's pride for a moment. Let's talk about their charitable intent. Let's use some legacy language, whether it be for, the church, whether it be for, the Heart Association, whether it be for their children. And we can leverage, we talk about leverage versus other investment options. Again, looking at that internal rate of return. So even though they say it isn't needed, one thing I always talk about is how it can be leveraged from a perspective of diversifying their fixed portfolio, right? David's 58, he's probably still got somewhat of an aggressive approach to his retirement assets, right? So people are going to have, riskier money than safe money, and that safe money has to be diversified itself. And so this is a strong play for helping diversify someone's safe money. And what if, we find out they're afraid the policy, they're afraid of the policy underperforming? Well, again, this policy will only grow with dividend payments. There's no variable risk, right? That we don't have investment options, and there's no stated crediting rates. This is a policy that requires one premium. It's going to have leverage immediately, and so that's how you might address that as well. And of course, this product does allow access to the funds at any time. Now, what would be a sample close? Well, by exchanging your current policy, you can preserve the remaining cash value while maintaining access, eliminating future premiums, and create enough death benefit to cover final expense and add to your retirement fund for your wife. Do you agree that the next step is completing the paperwork? So we kind of, in this situation, we're restating the benefits, the obvious benefits to the client, and we're asking if we can move forward with the paperwork. The next sales idea, and again, I want to keep this on time so we've got the opportunity for some questions, is self-funding final expenses, right? So we have a client, her name is Judy, she's 70 years old, she lives alone, and she's on a modest income. What we know is that she's got grandkids who live in other states with her children. She hasn't been able to visit them for several years because of her income level. And we know that she doesn't, believe there's a need for life insurance, right? She's got the money set aside. She's got $15,000 in savings that is earmarked for her funeral. And she's also under this impression at age 70, she's really not going to qualify or be able to buy insurance. What does this look like here? Well, in this situation, we could take a portion of that $15,000, reallocate it, take $10,434, and buy her a $15,000 death benefit. So right now, this notion of what she has saved to pay for final expenses is really replaced, but at a fraction of the cost, right? $10,000 versus the $15 for dollar. We're able to free up money, over $4,500, where now she can actually go visit the grandchildren, visit her kids, or whatever else she may choose to do. And again, if dividends are paid, there's this idea, and we've been paying dividends. Dividends get paid into a participating policy. Not only does it drive up the cash value, but that cash value being driven pushes the death benefit. And what we want to see is that, by life expectancy, we've been able to maintain that or increase that death benefit to maintain the pace of inflation for those funeral costs, right? And how do we get this conversation started? So is this trickier than the others? Well, not really. What we're able to do is we're able to say, look, have you or your family had to pay for someone else's final expenses? right? Very straightforward. If that's an experience they've had, it makes it very simple to have them, kind of say, look, yes, we have, it was X amount of dollars. There's a story behind there. Do you currently have assets set aside to cover funeral costs? So you're asking them, how are you handling yours? Or do you currently have a permanent life insurance policy to cover final expenses? Right? Those might be some conversation starters. And then what could be the objections there? Well, access to funds, right? They've got it in the bank. They can access it anytime they want it. There's this idea of, the bank is paying some type of nominal interest rate, but there is some money that's being added to it. And while it's earmarked for funeral expenses, it could grow with interest and hopefully in their minds, maintain the cost of increased funeral expenses. And then, again, she wasn't even aware that maybe at age 70 she could still get coverage, if her health's good. So that would be another concern. She's too old to get life insurance. Now, let's just talk about the objections for one moment. With the objections, just to kind of play on this some more, we've got to expose the objections all the way through. And you're going to do this by using questions to allow the prospect to really elaborate on the basis of his or her objections. You're going to ask questions that are curious rather than impatient. Some good questions are, what is the basis of your fear, or what information would be useful to help you make a decision? If I get back to you in a week, what will have changed? Is there a difference between now versus later? Or if it weren't this solution, would there be any other, or this objection, would there be any other reason keeping you from getting started? So that would be pinpointing that this is really the one thing that's really keeping us back from moving forward. And you're going to respond with benefits. You're going to respond I understand your concern about the inflation. Can you see how the reinvestment of dividends with this product will help keep pace with the rising cost of funeral expenses? So let's take one step further here and talk about, the sample close. Not only will your children be relieved when they know the funeral costs are still covered, but they'll be excited to learn that you can come visit the grandkids now. Would you like to begin the paperwork? Again, we've been able to kind of open up the conversation, prepare ourselves for some common objections, and then, have a sample close of moving this forward towards the paperwork. Again, the whole idea here is helping you drive to get the sale and drive some additional revenue. So today, what we've been able to do is talk about the value of Insurance Advisors Direct, learn a little bit more about Bernard and his approach and how he can help, by partnering with you, grow your business. We've talked about how do we take some of the product reviews that we've done with IAD over the last several months, where Andy's led these product reviews, and turn those into a sales concept specifically with our single premium whole life. And then what we've done is talked about 3 very client-centric solutions. I would tell you that, it's not enough just to think about the money. Because there's a lot more value to cross-selling your client base. Cross-selling opportunities should help a customer solve a problem. That builds loyalty. If you sell someone Medicare Advantage plans or Med Subs, and then cross-sell them on life insurance, it tells them that you have access to products that can solve multiple problems for them. And why would they go anywhere else if all their solutions can be done in one, solved in one place? As long as you don't try to pitch them on products they don't need, and as long as you're willing to take no for an answer, cross-selling will strengthen your relationship with existing customers. Again, this is because they see you looking out for their needs, not just trying to make a buck. One of the elusive advantages of cross-selling is that it can increase leads. If you have loyal customers who feel cared for, they will be the first to recommend your services to someone else. So not only are you getting leads, but you're getting the best kind of leads, referrals, or what I like to refer to as introductions. Okay. Now, what are the next steps? Well, if you're not currently appointed, and we've had good success with the webinars with Bernard here in the past, where people then turn around and they get appointed with Assurity. But if you're not, that's the very next thing you want to do today is you want to get appointed. And then if you have clients in mind, if you've talked to clients, if you go out and have that conversation, you understand the type of illustration you need, then we want to get the illustration together. Who can you do that through? You can do it directly with Bernard and IAD. You can do it through our AssureLink agent portal. So once you're appointed, you have access to that. Or you can call our Assurity Contact Center, and they can help get the illustration for you on the spot. The other thing you can do is know that what your application options are. And we can do this through an e-application or the traditional paper app. And you're going to have 2 versions of each. There's a full e-application and there's a tele app e-application. There's a full paper app and there's a tele app, full paper app, right? Or a paper app. And what that means is you're going to go ahead and you're going to ask a lot of the health-related questions, or you're going to turn it over on the tele app side and allow a member of the Assurity team, who are Assurity employees, working at our home office in Lincoln, you're going to allow them to go through a reflexive question today with your clients and help you kind of offload some of that, again, making business easy for you, offload some of that personal information about your client you may not want to know, or the additional time it takes to go through the medical questioning. And then, I'll just quickly show you, if you are appointed, this is the AssureLink web address. It's assurelink.assurity.com. What you have out there are quick links. Under the quick links, where you can get the applications. We've got the product center where you have product-specific information. There's information around marketing and training. You can see cases that you've sold. And then, of course, there's always information about our Leaders Conference, which we're not going to spend much time getting into today. So with that, Bernard, I know we're right on the cusp of time. I apologize. I was hoping to leave about 5 minutes. We've got about 2 or 3 minutes here. Were there any questions that came up from the webinar today?
Tim, I do not see any questions, my friend.
Well, it couldn't have been that good. Look, folks, if there are no questions, that's okay. What we want to do is we want to be able to bring this type of approach. We're not trying to be demeaning. We're just trying to help you bridge something that's outside your comfort zone with some simple ideas, simple approaches. And if it's all the same to you, give the feedback to Bernard on it, whether this was good, was it beneficial, and if it was, if the feedback is positive, we'll do this again and we'll look at term insurance, or we'll look at our whole life product, or we can look at some of the other things that we offer. But based on the survey information, we want to focus on life insurance first and foremost, and be able to approach your current customer base, which I think we should have been able to do today as it relates to pre-retirees and retirees that you're working with day in and day out. So, folks, again, Bernard, I'll check one more time. Are there any questions? Okay.
No,
there's no questions. Again, I'm sorry, Bernard?
No, I'm saying there's no questions.
Okay, excellent. Well, folks, appreciate your time. Bernard will be in touch. Andy and I are available. If there's anything additional that we can do or answer for you, please let us know. We appreciate your time. We appreciate the fact you continue to make an investment both in your business and in this industry. Thank you so much.
Thank you, everyone. Catch you next time. Bye.